Hi, my name is Jordan Wilson. Today we're back to take a deeper look at the buy and hold investment approach. In our last episode, one of the legitimate concerns of buy and hold is that it may not deal effectively with market volatility. And that's true definitely in theory, possibly in practice. Buy and hold is quite literally identify an asset, buy it, and then you hold it until you reach the end of the time horizon that's associated with the objective you want to reach. You're not trying to jump in and out as the markets move. So how can we use buy and hold, or how can buy and hold better cope with market volatility? The first point I would make is just time horizons in general. Now, we saw that over the long run, and that might be 50, 100 years, appreciable assets appreciate. And that doesn't matter if they're low risk T-bills or high risk small cap foreign equities. Over time, you see the trend upwards in return. And the greater the risk associated with an investment, the greater the expected return over the long time period. And fortunately for investors, a prime investment objective is usually saving for retirement. If you're 20, 25, and you don't need to access that money until you're 70, you may have a 50-year time horizon, ample to withstand the ups and downs in the shorter term. But as you get into the 50s or the 60s, then the time period has fallen. And the market volatility can definitely impact you. The same is true for short-term, mid-term objectives with less time horizon. Now, what I will say is that when we looked at market volatility in prior episodes, we saw that in a few cases, obviously after the 1929 crash in the 60s, it could take 2 decades or more to recover. But if we look at things sort of on an average basis, and I pull out some Invesco data, and they talk about bull and bear markets. And a bull market is basically a prolonged market period in which an investment has prices that rise faster than the historical average. It's typically characterized by a stock market increase of at least 20% from its previous low. A bear market is the opposite. It's typically characterized by a stock market that has fallen at least 20% from a previous high. If we look at the Invesco data from the end of 1968 until the end of 2020, we see that there really only has been 7 true bear markets. The average bull market has run much longer in length. It's averaged about 1,764 days in length. So not quite 5 years, but 4.8 years. Whereas the average length of a bear market has only been 349 days. So just shy of a year. So if we see the stock market in a down period, we've tended on average to see about a 1 year price decline. Now, for the investor who was fully invested before that decline, you also need to factor in the recovery periods. And if we look at sort of Goldman Sachs, CNBC research since World War II, it's taken on average about 24 months for the S&P to recover once it comes out of its bear market. So in this scenario, combining the Goldman and the Invesco, you're looking at probably 3 years to get back to where you were. Now we can cite specific examples of much longer, but on average, since the 60s, that's kind of where you would expect a bear market to be running. The actual bear, about a year, and then a couple more years to recover. I think a caveat is, right now, the markets are at incredible highs. So one would expect that if and when they do correct, it might be a larger correction than an average, because the average would have been at much lower levels. But that's kind of where we are. So historically, your time horizon to deal with a bear market and recovery might be 3 years, let's say 5 years on average. And keep in the back of the mind that it could also be a huge correction that might take a couple of decades to get back to where you were when you started. But that's kind of where we are as far as the time horizon, is that for most people who do have a 20-year time horizon on their investments, especially retirement, that 3 to 5 year down and then recover period isn't the nightmare that you might think it is in having to jump in and out. I think another point just to make is that I think today's investors are a lot more knowledgeable on the investing process and on the concepts. And there's a lot more investment accounts that they're utilizing. So people are investing earlier. It's not, oh, I've got to wait till I've paid my house off and I'm in my mid-40s. And now I got to start thinking about supplementing my employee pension plan. It's, oh, okay, I can get a tax deduction for my registered retirement savings plan. Or there's a tax-free savings account that I can use. Or I want to put my child in college in 15 years, so there's a registered education savings plan. In the US, similar. I think if you look statistically, a lot more people are using deferred and tax-efficient accounts. And that's an incentive for them to invest sooner, which gives them longer time horizons. The second point I'd make on the investing basics is your target asset allocation. When we looked at asset allocation, we saw that it's directly derived from your unique investor profile. And that factors in your risk tolerance, your financial situation, constraints, and your personal financial objectives. We ranked financial objectives by low, medium, high priority, and by short, mid, long-term time horizons. And then when we built the portfolio, the asset allocation part, we wanted to match investments with financial objectives. If you intend to retire in 50 years, we can take on investment risk, because that's the volatility, the standard deviation, how much the actual return will deviate from the expected return. And that difference is the standard deviation, the variability of the returns. If you are funding a wedding in 6 months' time, then you probably don't want to take on the risk of investing in Tesla or emerging market small cap equities. You probably want to put your funds in a term deposit for 6 months where you get the full capital with 100% certainty at the end of that period. Similar if you're buying a house in 3 years. You want some certainty that your down payment will be available at that time. So again, we want to look at the risk-return relationship and then the assets themselves and match them to our objectives. And that deals a bit with the volatility because for the shorter term objectives, we've taken out and we've moved away from that volatility, that risk of the investment. So just by our asset allocation construction, we're already addressing market volatility concerns. And if you're young with 50 years, then you want increased market volatility because in the long run, that's beneficial. Another basic that deals with market volatility is diversification. We don't want your portfolio to have all its eggs in one basket. We want to diversify. And if we look back to our systematic and non-systematic risk discussions, diversification definitely reduces non-systematic risk because that's the risk that is specific to that asset. And we used Starbucks examples where a Starbucks, even on the same city street, but kitty corner, will have slightly different factors that impact profitability of the individual store. Better baristas, a worse manager. One's in the bottom of a busy office building. One's on a high traffic corner. So there's sort of these things where by spreading out your investing patterns through different assets, you can diversify away that individual company asset specific risk. Diversification can also help with the systematic risk. And the systematic risk is the risk that impacts all companies to a certain extent. If coffee prices go up, that's going to impact both Starbucks, regardless of who's the better manager or who has better baristas. If interest rates rise due to inflation, that's going to impact most companies to some extent. If mortgage rates go up, it doesn't matter how good a credit rating you have. When you go in for the loan, you're going to pay a higher rate just because the general interest rates have risen. But by diversifying, we can help address the systematic risk because we're looking for assets with low to negative correlations to each other. And we talked about correlations. This is kind of why, they're not always low return, but the stereotypical low return, safe, boring, fixed income product, Canadian government bond, a US Treasury bill. Compared to equities, historically, they've offered very low returns. But currently, there's a low to negative correlation. And what that means is that when equities rise in price, the fixed income will underperform. But when equities fall, assuming it's still a negative correlation, fixed income will go up because they're moving in opposite directions. the closer the correlation is to a positive 1.0, the closer that they'll move in lockstep. As you move down to 0, there's really no connection between how one asset performs versus the other. And when you get down towards minus 1.0, which is the other end of the spectrum, that means that as one asset moves up, the other asset completely moves the other direction. And you don't see a lot of negative 1.0 correlated assets. But again, if you can get down at minus 0.2, that gives you some diversification and some protection should there be market corrections on the equity side. So you see that just in our portfolio construction, as far as the asset allocation and the diversification, we're addressing some of these market volatilities so that we can try to reduce the risk without impacting the return. If we move over to the actual portfolio construction itself, passive investing is one of the things that we've been discussing. And yes, buy and hold isn't great for timing markets. But we've also seen that even professional money managers have a very difficult time properly assessing market corrections and fluctuations. And we saw that from 20 years in the S&P 500. If you missed the 30 best days that the market was up out of almost 14,000, your portfolio was impacted negatively by 81%. So that's an issue, is that if the professionals jump in and out even a few days and they miss out, huge impact versus buy and hold. So maybe holding tight in a passive mode isn't as bad as people make it sound. And until I start seeing statistics showing me that professional money managers do time it correctly more often than they don't, then buy and hold may actually be better. Dollar cost averaging. This is a good one for the volatility side. And again, you combine the dollar cost averaging with the buy and hold. It's buy and hold, but you're building positions over time. So with dollar cost averaging, you are investing a fixed amount consistently over time. And if we say that's $1,000 every 6 months, if the S&P 500 was trading at $10 and you're buying $1,000 worth, you're going to buy 100 units. Suddenly it's gone up to $20. You're still putting in the same amount, 1,000. So you're getting half what you would have got at the original price. But then there's a correction and we fall into $5. Suddenly that $1,000 gets you 200 units instead of the 100 that you were buying on day one. So basically during a bear market or a down market, you're buying additional units on sale because we know that over time the asset will appreciate. So in some ways, even though it's a down market and you're probably a little depressed, you're also able to buy additional shares of an appreciating asset at a discount. So it's not that bad. And again, if you've got that 30 or 40 year time frame, nothing wrong with seeing a market correction and being able to jump in and add to your weighted average cost. And the final point I'll make is on cost minimization, something that I would preach in a passive investing approach. and in the buy and hold approach, because that's passive, is you want to keep your costs minimal. And we saw when we looked at mutual funds, actively managed, management expense ratios, including the management fee of the professional asset manager. You're seeing funds that have over 2% in fees. If my equity fund or my equity index, say the S&P 500, is averaging maybe 8% per year in return, which is a realistic number, and someone's charging me even 1.5%. Now, if we're in a bull market and the market's returning 14 or 15% on that index, 1.5% doesn't sound too bad. But if we're now in a bear market and it's churning out 1% or it's negative 4%, and suddenly my mutual fund says, hey, buddy, you still owe us 1.5% in your MER. So instead of like breaking even or losing 4%, now it's suddenly, instead of losing 4%, which is what the index lost, I'm at 5.5% loss. So with a passive strategy, cost minimization is paramount, and we want to be in a index fund that's running 0.05%, 0.07%, so that if the market does lose 4% in a year, you're not taking it on the chin for 5.5%, you're taking it on for 4.05. And again, that adds up hugely over time. So that's sort of where we are with market volatility. Is one, I'm not sure market timing actually works on a consistent basis for professionals. So yes, if you can market time, it's better to go that route. But if it doesn't work and you miss out on some of the good days, that's going to hurt you more than trying to market time. And then just the good investment basics, diversification, matching your goals, especially the time horizon and the level of risk, to actual investments. Dollar cost averaging, passive investing with focus on cost minimization. All these wrapped together with the buy and hold strategy do make it a much more effective way to deal with the market volatility that you're going to face over the next 50 or 100 years. Okay, that's enough on market volatility. Thank you again for your time today. Have yourself a good one.